Hello, everyone. Thank you for joining us for this session. We'll be discussing fund infrastructure and custody and trading. My name is Matt Gorm. I'm the Chief Operating Officer at Pantera. Also on our panel is Ryan Davis, the Chief Financial Officer at Pantera, and Dennis Chow, Director of Trading. We can start the presentation. To begin, we're going to go over some of the basics of custody. The heart of custody is based on storing and securing the private key. That is a string of alphanumeric characters, basically a password. It links with the public key, and that will create your public address. There are two types of wallets that are commonly referred to. There is the hot wallet, and these are wallets that are connected to the internet. Primary hot wallets that Pantera interacts with are exchange wallets. During their course of business, they have withdrawals and deposits constantly occurring via the internet, and they need to have their wallets connected to the internet, and we will interact with exchanges through trading. And the other wallet is the cold wallets. These are offline wallets that are more secure than the hot wallet, and they are held on custody that we are with. The custody options are third-party custodians. We utilize Coinbase and BitGo for our primary custodians. They have secure setups where we can set up more secure setups for our users. We have multiple people that can access our custodians. We can set up multiple users that can initiate and approve wallet movements. And we also use exchanges, as I mentioned before. This is primary for liquidity purposes and trading. And then we also have self-custody on hardware wallets for assets that aren't available on custodians or exchanges. The primary benefits and downsides of each custodial option. With third-party custodians, you have full service and support, massive infrastructure of the company. You often get trade execution. They specialize and have expertise in custody. They often carry insurance. There's multi-signature wallets, which I mentioned before. We have one person that will initiate transactions. It will require multiple approvers. And then for extra security, there will be a video confirmation, and then they will move the assets. The risks of the third-party custodian is it does increase counterparty risk. There are costs associated with it. It does take time to move assets from cold storage, and there is regulatory risks regarding custodians. When we hold assets on exchanges, the primary benefits is it provides liquidity for our funds. We can trade quickly and change our exposures in our funds. Often they sometimes do have insurance. The downsides does create counterparty risk. Most of the wallets on exchanges are hot wallets since they're constantly trading, and there also is additional regulatory risk. when we self-custody, we carry no counterparty risks. It provides flexibility to move securities wherever we want it to. It's quick, it's low cost, and we control our keys, and it's relatively private. The downsides is that we're fully accountable, and it does open us up to the susceptibility of theft, and there is a steep learning curve to new tokens that come into the portfolio. With that, I'm going to pass it to Ryan, who will discuss institutional custodians.
Thanks, Matt. Yeah, just taking a few minutes here to talk about the institutional custodian space. And as you can see from this graphic, a lot's changed between 2013 and today. And back in 2013, there really weren't very many choices in terms of custodians. As an institution, you might be forced to choose between a custodian that may have deep cold storage, high level of security, but maybe a slow process to get the cryptos in and out of their platform, versus a platform where maybe you could move cryptos faster, but you might have to give up some level of security, or they might not have all of the cryptos as part of their menu that you wish for them to hold. So really, what's changed between now and then has been a pretty steep increase in institutional demand for digital assets, and that's really played a large role in pushing the growth and expansion of institutional custodians in the space. Institutional due diligence just requires a much higher level of transparency around security and control testing, faster processes to on and offboard cryptos on their platform to trading and exchanges, and complementary products that traditional financial institutions offer that now institutional investors in digital assets now demand. And a lot's changed since 2013 to today, but really since 2018, what you've seen is a number of new entrants into this space. And so seeing companies like Bakkt enter the space, and Anchorage, both of those companies launching their custodial operations, Coinbase acquiring Zappos custody operations, and really more recently, larger financial institutions like Fidelity and Bank of New York Mellon getting involved in this space. And so you can really see, a push for the growth that's happened over the course of the last 3 years. And very recently, just as an example, we had a due diligence call with Coinbase, kind of to review their trajectory over the course of the last 3 years in terms of their operations. And on that call, there were some pretty amazing growth numbers that we're looking at. They've grown their custody business over 90 billion over the course of the last 3 years. In 2018, they custodied something like just a handful of crypto assets, where now their platform holds over 90. And during that period of time, they've increased their security protocols, have a zero theft rate, and increased their insurance by 3x. So this is just kind of an example of how the custody space has really been retrofitted to meet the institutional demand in a very short period of time. And next, I'm going to talk about, just take a minute to talk about, well, what do we look for when we're custodying or when we're assessing institutional custodians? And the first most important thing is security. And so we will review extensive security and control testing just to ensure that each custodian has kind of gone through these battle-tested periods over multiple cycles and have been assessed by third parties regarding their control environment. And this testing is usually done by companies like Big Four auditing firms, EY, Deloitte, firms like that are, their practice is to review the design and implementation of controls. That's the business they're in. And so the tests that they perform and what we'll review are everything from testing internally inside the custodian's operations, how they handle the crypto, how they store it, how they move it from one place to another, to their interaction with institutions like us. How do they interact with us? What are the controls around how we approve moving crypto in and out of their platform? And so all of those interactions are part of ensuring that you have quality security around the place that you're storing your crypto assets. So that's one of the biggest things that we look at. Another one's obviously track record. So, a zero theft incident rate, a track record of enhancing your security controls over a period of time are obviously very important. But also that the custodian is evolving across their corporate structure, that they're a well-capitalized organization that can stand the tests of time. And that's really, what we will want with anybody that we're going to partner with to hold assets. Another couple things that are important to us is that ability to transition from custody to trading relatively quickly. Our operation demands that, so that is a demand that we have of our custodian. And the platform has got to support many different cryptocurrencies so that we don't have to continue changing venues. It makes it a lot easier on our operation. And just 24/7 support as well. I mean, we're going to need help from time to time. We're going to need to understand the changes on their platform, not just on the diligence side, but on the operational side. And so the custodian being there for us when we need them is obviously very important. And then finally, complementary services, additional ways to generate yield through services such as, lending and staking. Those markets have matured and become a big part of the cryptocurrency landscape. And, those are certainly things that we would look for in a custodian partner. So now I'm going to pass it back over to Matt, who's going to talk a bit about staking.
Yeah, we hold a number of positions in our portfolio that utilize proof of stake network, and we stake these positions to generate additional yield. We often hold these positions for long periods of time, and to get the additional yield and to strengthen the network, we will stake the assets. One of the benefits of staking is that it's much more energy efficient compared to proof of work. The more you stake on the network, the higher proportion of the stake, the probability you'll be chosen to receive the fees generated by staking. The one risk involved with staking is that if you act nefariously or confirm a fraudulent transaction, it is possible that your staked assets could be slashed. We hold 9 assets that we stake for our funds. The average yield on these assets is 10% annual, and you can see that some of the assets that we stake are Polkadot and Luna, Sushi, and Near. All right. So I would like to pass it to our Director of Trading, Dennis, who will discuss our trading infrastructure.
Great, thanks, Matt. So, just to recap, we do have a number of different funds and strategies. And so the trading for each strategy varies, each fund varies. And so at the core, we have our Bitcoin fund, and that's a single asset fund. And then going out, we have our digital asset fund, or liquid token fund, which has a broader token universe. And then we have our ICO or EST funds, which do pre-deal tokens, pre-trading tokens. So, the various trading methodologies around those varies based on the fund and the strategies as well. And Terra utilizes both a quantitative and discretionary method of determining target positions. The vast majority of our funds and assets are just using discretionary. So it's basically the investment committee deciding what our target position should be. But we do also have a quantitative strategy within our liquid token fund that is computer driven, machine learning computer driven, and that we use the tools that we've developed on the quantitative side also on the discretionary side. So it's not totally mutually exclusive. There are different types of exchanges. So, most people, when they come into crypto, they'll start trading on a centralized exchange. So that could be like Coinbase, Bitstamp, Bitso. And these are very familiar because the traditional financial world works with a central limit order book. However, in decentralized exchanges, in DeFi, in crypto, specifically in DeFi, you do have decentralized exchanges as well, which are typically smart contracts. They may or may not have central limit order books. They could be using an automated market maker. And there are various reasons why you would want to use a decentralized exchange versus a centralized exchange. Access to tokens, for example, is much larger. And so, if you're dealing with early stage tokens, the decentralized exchanges are typically where you'd see them first trading. So again, this is the exchange ecosystem. On the centralized side, you have Coinbase, Bitstamp, Bitso, Binance, Kraken, Bakkt, FTX, and so on and so forth. And then on the decentralized side, you have a combination of these decentralized central order limit books, as well as liquidity pools. So as an institutional investor, typically the problem you face is whether you want to use your own accounts across multiple exchanges, or whether you want to use a prime broker that kind of aggregates liquidity across exchanges. And both methods can get you basically best execution, finding the best price for the token, regardless of which exchange it's on. Having said that, there are pros and cons to each. If you choose the execution management system route, there's a larger operational burden, and you typically are constrained by the exchanges themselves. So you typically will find, that the customer service at some of these exchanges isn't as great as what you'd find in the traditional world. And then on the flip side, while the prime broker does simplify execution for you and operational burden, there's a lot of limitation involved. Their universe may not be as wide as the universe that you'd get from a exchange, or it could be that you just don't have the same kind of flexibility to pick which exchange you want to trade at. And so from here, I'm going to go into what Pantera has done. Let's see. So, our Bitcoin fund, as I mentioned previously, is kind of the core flow for how crypto works. So we have, very simple subscription redemption model on a daily basis. The subscriptions go into the bank, or if there's redemption, we'll pull tokens out of custody. We'll move them to an execution channel. And so that would be a liquidity aggregator or prime broker. It could be exchange, or it could be an OTC desk. We'll trade, and then from there, move the tokens back into custody, or move cash to the banks for redemptions. There's a trade capture process, which basically pulls all of the executions into a proprietary portfolio management system, and then also sends data downstream to our administrator. There are also a number of checks and reports that are created from there as well. The digital asset fund or liquid token fund is very similar. It's just that it has a much larger trading universe. It's also multi-strat, so it does have 90% of it is discretionary, while 10% of it is quantitative. On the discretionary side, it's semi-automated, meaning the token universes may not fully overlap with the venues that we have automation for. So to the extent we can leverage prime brokerages, we will. To the extent we can leverage exchange accounts, we will. And then if it goes beyond that universe, then we'll use DeFi to execute. We also have a medium-term kind of holding period, and we'll try to maximize our assets by lending them as well. On the quantitative side, it is fully automated, and it rebalances hourly and trades even more frequently than that. And because of that, all of the assets are custodied on exchange. And finally, for our early stage token fund, the early stage token fund primarily acquires assets through deals with projects. But then when we want to exit the positions, we will execute, through the various channels. It's a long-term holding period. Typically, there's a SAFT, and we'll have to self-custody or use a custodian if possible. And with the early stage token fund, we find that most of our staking is done out of that fund. Finally, just kind of looking forward at the industry, and Brian touched on how custody has grown in terms of providers. I think that'll continue. We see more and more institutional players enter the space from a service provider perspective. I think the usage of DeFi will continue to grow, especially as there are just a lot of things that you can't do in traditional finance that you can do in DeFi. For example, if you wanted to borrow money for a short period of time, that's possible within DeFi. You could borrow it for a block, for example. That's not possible in the traditional world. I think there's going to be improved liquidity. We've already seen that with Bitcoin and the top 10s, but also across the small and mid caps. There's been more market participants, and with that, I think we'll see liquidity continue to increase. And then finally, I think something that's been stopping a lot of institutional investors is regulatory clarity. And our next session is based on the regulatory outlook, so they'll talk a little bit more about that. So I think with that, we will pass it off back to Paul, and we can start the next session.